I'm Clara Hermit and this is Mould on Markets, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you?
Very well, Clara. How are you?
I'm not too bad at all.
Good to see you again.
It's very good to see you as well. Russ, what is it that clients and their advisors should be thinking about at the moment?
We've got a little smattering of macroeconomic news coming up over the next week or 10 days. We've got UK industrial production and manufacturing output on the 11th, Japanese machine tool orders on the same day, and US retail sales on the 12th. Now, in the end, I think all of that's going to pale into insignificance compared to horse racing's Cheltenham Festival, which is the 10th to the 13th. And although a lot of advisors and clients are going to have their attentions focused on the Cotswolds, I'm sure that at the same time, they'll be looking very closely at the FTSE 100, but also America's NASDAQ Composite. The FTSE 100 has finally got to that magic 69.30 previous all-time high. Looks making heavy weather of pulling away from it. But the NASDAQ is now bearing down on its previous peak of 5,048, reached in March 2000.
Wowzers. That is a history lesson for us right there.
University for nothing, you know.
Just so you could help us out with that little fact.
Absolutely.
So that is, of course, a history lesson. But why has it taken so long for both indices to reach a high when America's Dow Jones and the SP 500 have already set multiple new highs?
It's a really good question. The simple answer is mix and valuation. If you look at the FTSE 100 and the NASDAQ 15 years ago, very, very heavily exposed to technology, media and telecoms. And as that bubble burst, and a lot of the market caps collapsed, that weighed on those indices very, very heavily. I think 20 odd tech, media, telecoms companies went into the FTSE 100. Most of those then sluiced out, and that's weighed on the index for a very long time. They were eventually replaced by oil and mining companies, which helped and is now hindering. But I think it's the first explanation is definitely simply down to mix. And NASDAQ's been very, very tech heavy. It's now more biotech led, interestingly.
Okay, so that's mix. What about valuation?
Yeah, valuation is obviously critical. In the end, the price that you pay for a security is the ultimate arbiter of performance. And I think what you're looking at there is the FTSE 100 at the moment isn't too bad. The chart behind us shows, based on numbers from Thomson Reuters data stream, that the market has averaged around 17 times earnings over the past 20 odd years. And it's basically trading absolutely bang on that now. So it's not bag and bucket cheap, but it's not particularly expensive either. And it's quite capable of overshooting to the upside if earnings momentum is strong enough. As history shows, again, you get some big spikes there. Equally, accidents can and do happen when the market is trading well above those averages and earnings come under pressure. Now, at the moment, the historic data show valuation and corporate earnings power are about normal. The next chart shows the valuation, again, that long flat line showing you the average. The next one is the year-on-year change in aggregate UK corporate earnings. According to the Office for National Statistics, it's about £90 billion a year right now. And it also shows you that figure as a percentage of GDP, which is that wiggly line that slowly advances. There's gradual improvement over time to around the 6% of GDP mark, and there's nothing to suggest that differs too much from historic norms. If there is a worry, it's that profits growth is actually slowing down, and it's getting quite close to zero right now.
And how does the US valuation picture look?
Very different, which is very interesting. Now, the US version of the last chart, corporate profits growth as a percentage of GDP, looks totally different. The figure is up at around 13%. Now, A, that's twice the UK average, but B is actually twice the long run average you've seen from America itself. So that's particularly interesting. And again, also what you've got to see on the momentum side is there is a little bit of a fade there. But the big number's that 13% one, because it compares to the 4 to 8% range we saw in the 80s, 90s and noughties. Now, why? Could be productivity, America's dynamic entrepreneurial spirit. It could just be inequality and poor wage inflation and corporates squeezing hard on the staff. Now, whatever it is, it's remarkable. It's all the more telling when you look at equity market valuations. The cyclically adjusted price to earnings ratio, CAPE, devised by Robert Shiller, shows that American stocks have only been expensive on more than 2 or 3 occasions than they are right now, including 1929 and 2000 when absolute disaster struck. Now, the positive spin on that is record profits can help to justify record levels on the indices like the Dow, the S&P and the NASDAQ, with sectors like tech and biotech having a lot to do with the productivity argument. Skeptics will argue you're paying near record high multiples for near record high earnings, at least on a percentage of GDP basis, at a time when earnings growth is slowing. Now that can be a treacherous combination. So we'll see who proves to be right and whether the NASDAQ can join the FTSE 100 in breaking fresh ground or not, and so whether US stocks overall continue to march higher.
Okay, thank you, Russ.
Pleasure.
And thanks for joining us. We'll see you next time. Goodbye.